This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So, in the last bit of that video, we said don't worry so much about the changes in the assets and liability values go. Well, this is where it goes. Okay, this is where we'll quickly, very briefly talk about it. It's regards to the presentation and disclosure. And again, when you look at the individual financial statements, or I should say the accounting standards, they give you the information about what should be disclosed and also about how those figures should be presented within the financial statements. Presentation, again, covered more in IS 1. So what you've then got, if you like, is the changes go through your statement of profit or loss. That's the primary source, isn't it, about how a company has performed. So changes in the asset, change in the liabilities value. Again, linking it back to the definitions of income and expense. So income being increases in assets, reductions in liabilities. Expenses being reductions in assets and increases in liabilities. Those changes are going to go to your primary source of information on performance, which is your statement of profit or loss. Okay. However, the standard, I say standard, this isn't a standard, it's the framework. Apologies. What it then goes on to say within the framework is that any changes in the current value, so remember, changes in current value can come around from changes in fair value, changes in your value in use or fulfillment value, or change in the current value. Yes, they're going to go through profit or loss, but it says they can be recognised through other comprehensive income. So we've seen that before, haven't we, with regards to your evaluation of property, plant and equipment. Okay. It can be recognised through other comprehensive income instead, because effectively it has yet to be realised. Okay, you will see other changes go through other comprehensive income when we get to financial instruments and looking at the change in value of your financial assets, particularly there with your equity investments, and the changes can either go through profit or loss or other comprehensive income. But hold that thought for now. It also then goes on to briefly mention reclassification. So you can go through and take what's been recognised in OCI and transfer it through to profit or loss if it gives more relevant information. So again, going back to the qualitative characteristics, if it is relevant to show it in profit or loss and reclassify it that way, then do so. If not, just process it as a reserve transfer, which is effectively what we do with regards to PPE once it's been revalued. The gain goes through OCI into your evaluation surplus, and then when that asset is derecognised, we do a reserve transfer that takes the gain from your evaluation surplus into your retained earnings through the statement of changes in equity, because it's not more relevant to reclassify it to profit or loss, because that gain was made several years ago. It has now just been realised, so it's not so relevant to recognise it in profit or loss now, is it? But there are some items whereby that can happen, and again you'll see that specifically in some of the accounting standards that follow later in this syllabus and in strategic business reporting.